It's been a volatile month for the 10-year Treasury yield as the coronavirus continues to panic the bond market. Joining us now on the phone is the CIO of Global Fixed Income at Morgan Stanley Investment Management, Michael Kushma, along with Jared Blickery over at the Wi-Fi Interactive Board. Michael, thanks for making time for us today. I'm going to start with the bond market, the credit markets. Do we have a liquidity problem in the credit markets right now?
I think we do. There is has been a mass rush to the door, an exodus from risk. And lately, last week, we saw not only problems in liquidity in credit markets, but in the Treasury market as well, that when everyone runs to the door at the same time, there's a very small opening relative to what is needed at that point in time. And certainly one of the actions the Fed took late last week and over the weekend was to address the issue, at least in the Treasury market.
Jared Blickery here. I want to ask you about negative rates because Sunday night the 1-month T-bill briefly went negative. Is that something, although it's not the Fed's intended policy here, is that something that could come to the U.S. and what would be the implications of that?
I think it's unlikely to have the entire yield curve structure move negative, but at the very front end of the yield curve, there's clearly a problem in the commercial paper market and the prime money market areas in terms of a heightened need to sell shorter dated paper to raise cash that investors want to do. So the rush into risk-free assets, into government liquidity funds, can push T-bills, given the current muck structure of money market rates the Fed has implemented, to push T-bills into modestly negative territory. Although I think that from a policy perspective, the Fed does not want to see anything material below negative as we move further out from the sort of very short end of the Treasury bill market.
Michael, can you frame this for us? How shocking will corporate default be looking out over the next 3 to 6 months? That
is the question of the day, and that is what markets are grappling with. Right now, the credit markets have priced in probably 85–90% of a probability of a conventional recession. However, we don't know the true ramifications of this economic shutdown that's been rolling through the U.S. economy, how much further it will go. Corporate cash flows will be severely diminished in many industries and generally speaking as well, and that will have to be taken into account. We'll also have to see what kind of policy response there are in terms of forbearance, liquidity provisions by banks or by government entities to allow companies to tide themselves over. The airline industry and the leisure industry are clearly in the crosshairs of this issue, and those issues need to be dealt with.
You know, Michael, investors are demanding far greater returns for holding corporate debt right now. What are some of the winners, or where are some opportunities for those who have a stomach for corporate debt?
Well, I think the areas are with kind of like banks, because they've been turned into quasi-public utilities with all the extra regulations been put on them in the last several years since the last global financial crisis. And that has provided them with extremely strong balance sheets. So our view is you want to focus on companies that have strong balance sheets, have strong underlying working capital, can do well and certainly survive for sure what happens through an extended global economic slowdown. We've already seen in China what happens when you shut down an economy for extended periods of time. Well, actually just for 2 months, where industrial production fell 13–15%, retail sales fell 20%. I think in February, car sales fell 90%. Only that can't be sustained over months and months and months without putting companies' financial integrity in jeopardy. But just for 2 months, we can probably recover from that with some extra financial support coming from public sector entities or the banking sector.
You know, Alexis, it is amazing. This is a market that Jerome Powell has said that the market doesn't need negative rates, but that seems to be where the market is trying to take us.
It is. Michael Kushma, we want to thank you so much for being with us this morning. Jared Blickery, thanks to you as well.